Hi everyone, welcome back to my YouTube channel, and in today's video I will be doing some exercises on accounting equation. Before I begin with this, I just want to show you something that will be part of these exercises. So I want to show you how to calculate the markup. So the markup is the cost of a product. To arrive at its selling price, the markup amount must be expressed as profit. So the formula of calculating the markup, we take the selling price times 100 divided by 100, and we add the given markup percentage. So for instance, here we are given that the CD sold for cash was at 1,050 rands. The inventory markup was 50% on cost. So to calculate the markup, we take the selling price, which was 1,050 times 100 divided by 150, and the amount here we get 700 rands. So this is the markup. So let's begin with our main exercise. Okay. So here we are given the instruction. I don't know if you can see this. All right. So the following transactions occurred during January 2021 in the entity Selly Enterprises. The entity uses the perpetual inventory system, and all inventory is marked up at 50% on cost. Take note of this. So on the 1st of January, Selly, the owner, increased its capital contribution from 25,000 to 100,000 and deposited into the bank account. So first of all, we need to calculate the actual amount that we need to use in our book. So this is our general ledgers, and this is our accounting equation table. So we take 100,000 minus 25,000, and we get the amount 75,000, and this is the amount that we are going to use. And so first of all, we need to identify the two accounts in our general ledgers: the account that needs to be debited, and the account that needs to be credited. So we have two accounts here. We have bank and we have capital. So we debit the bank account, we credit the capital account, and this is how it's going to affect the accounting equation. It's going to increase our asset. At the same time, it's also going to increase our owner's equities account. Remember that capital falls under owner's equities, and so we have an increase in our owner's equities account, and bank we have an increase in our assets account. So this is going to increase our asset, and this is also going to increase our capital's our owner's equities account. And then we move on to the second transaction. The second transaction, you need to be really careful about this type of transactions. So here they say deposit cash sale for the first week, it was 9,000. It was 9,000 rent. So going back to our instruction here, we were told that all inventory is marked up at 50% on cost. So this type of transaction, any kind of transactions that has to do with sales, and we are given the markup at cost. So we need to calculate the cost of sale. We need to calculate the markup, and because of this, because of this markup, it creates two parts of these transactions. And when it comes to record this type of transaction, we have two parts. The first part, let's just look at the first part. The first part here, let's identify the two accounts in our general ledger. So this cash was deposited. So deposited cash sales. So the cash account, the cash was deposited into the bank account. So the cash account becomes the bank's account. So we have the bank account here, and we have sales revenue. Sales revenue is the type of income that we get from sales. Doesn't matter whether it's cash sales or credit sales. So any type of income that we make, the income that we make from sales is called sales revenue. So the two accounts here, we have bank, we have sales revenue, and this is how it's going to affect our our accounting equation. So it's going to increase our assets, and it's also going to increase our owner's equities account. Remember that sales revenue is an income account increase the owner's equities account. This is why we have an increase in our owner's equities account. And then we move on to the second part. The second part, first of all, we need to calculate the markup. I already gave you the formula of calculating the markup. So we take the selling price, 9,000 times 100, divided by 150. And we get 6,000, and this is cost of sale. This represents the cost of sale. So now, because of this, it creates an account called cost of sales, and cost of sale is an expense. So and remember that this has to do with inventory. This has to do with the stock or inventory that we sold. So the two accounts here, we have cost of sale and we have inventory. So the cost of sale is an expenses, and inventory is an asset. So we debit the cost of sale account, and we credit the inventory account, because the cost of sales account here reduce the inventory accounts. The money, this amount has to be deducted from the inventory account. So this is why we have to credit our inventory account, because we have a decrease in our inventory account. And so this is how it's going to affect the accounting equation. It's going to it's going to increase our asset, and it's also going to it's going to decrease our asset because of this inventory, and it's also going to decrease our owner's equities account because cost of sale is an expense, and expenses account decrease the owner's equities account. And then we move on to the third transaction here. They say purchase a second-hand truck on credit from Horn Trading. So the two accounts here to be identified, we have vehicle or truck, and we have creditor. So the account to be debited is vehicle, and the account to be credited is creditor. And so this type of transaction is going to increase our assets. So we have an increase in our asset. We bought a vehicle, so our asset increase, and at the same time, our liability account increased because we owe this money. We owe Horn Trading this amount of money, 34,000, and its liability. So our liabilities account we also increase. And then we move on to day 4. Day 4 here, they said, I don't know if you can see this. Day 4 here, they said, I paid cash for fuel, 4,450. So the two accounts to be identified here, we have cash and we have fuel. Fuel is an expense, so we debit the fuel account, and cash is an asset. But then we have to credit the cash account because we lost this money we lost this cash from the business when we paid for fuel expenses. So and this is how it's going to affect the accounting equation. It's going to decrease our assets because we lost cash. Our asset decreased, and it's also going to decrease our owner's equities account. We know that fuel expenses is an expense, and expenses account decreases. Expenses account decreases the owner's equities account. And then we move on to day 5 here. They say paid for telephone account by check, 2,538. So the two account here to be identified, we have telephone and we have bank. So we have check here, and check has to do with bank. So the two account, we have telephone and we have bank. So we debit the telephone account and we credit the bank account. We lost this amount of money from our bank account, from our business bank account, when we paid for our telephone bill. So we have to credit the bank account. And this is how it's going to affect the accounting equation. It's going to decrease our assets. We lost money as they decrease, and at the same time, it's also going to decrease our owner's equities account because expense decreases the owner's equity account, and we know that telephone is an expense, and so it decreases the owner's equities account. And then we move on to day 6. They say bought a mechanized inventory from Gary's Limited, 7,259 rand, issued a check number 355. So the account, first of all, we need to identify the account. We have inventory and we have bank, because this was paid with, we bought it and we paid with check. So it's obvious this money was from the bank. So we debit the inventory account because we have an increase in our inventory account. We bought. So inventory came in, so we have an increase in our inventory account. We debit the inventory account, and we have a decrease in our bank account. When we paid this check, we paid this amount of money through the bank account, so we lost money. So we we credit the bank account. And when it comes to the accounting equation, this is going to increase our assets accounts, and this is also going to decrease our assets account. So it's going to increase our assets account through inventory, because we bought inventory. The inventory came into the business, so we have an increase in our assets account through inventory. And at the same time, it's also going to decrease our assets account because we lost this money through the bank account. So we lost 7,295. So it's also going to decrease our assets account. And then we move on to day 7. Day 7, they say sold inventory on credit to S. Salties. So this transaction is almost the same as the second transactions on day 2, because it has to do with sales. And so we have to calculate the cost of sales. We have to calculate the markup. So the first part, so just like the second transaction, this part also has two parts. So first of all, we have to identify the two parts in the two accounts in the first part of our transactions. So the two account, first of all, we have S. Salty. S. Salty is our debtor, is our customer that we sold good to S. Salty on credit. So S. Salty is our debtor. So we can say debtor, we can say account receivable, or you can just put S. Salties. And so S. Salty is our debtor, and debtor is an asset. So we debit the debtors account, we debit S. Salty account, and we credit the sales revenue account. Sales revenue is a type of income that we make from sales. It doesn't matter whether it's credit sales or cash sales. So this time we made it from credit sales, and so we debit the sales revenue. We credit the sales revenues account. And this is how it's going to affect the accounting equation. This is going to increase our assets because debtor is an asset. It's going to increase our assets, and it's going to increase also. At the same time, it's also going to increase our owner's equities account because sales revenues and income account increases the owner's equities account. And the second part here, we have to calculate the markup. We have to calculate, I don't know if you can see this. Sorry. All right. I don't know if you can see this, but we have to calculate the markup. So the amount was 4,500 times 100 divided by 150, and we get 3,000. This is the cost of sale. So this type of transaction create an account called the cost of sale, and it's an expense. So the other two account we have a cost of sale, we have inventory because we sold inventory. So the account to be debited is cost of sale, which is an expenses, which is an expense, and the account to be credited is inventory. And so when it comes to the accounting equation, this is going to decrease our assets because of this inventory. The cost of sales reduce our inventory. So inventory decreases, so our assets also decrease. At the same time, this is also going to decrease our owner's equities account because cost of sale is an expense, and the expenses account decreases owner's equities account. So that is how it's going to affect the accounting equation. And we are moving on to the last three parts of the transactions. So on the eighth day, they said paid casual wage, cash, 600 rand. So the two account here, we have wage, we have cash. Wage is an expense, and cash is an asset. So we debit the wage account, we credit the cash account because we lost cash. We lost this cash when we paid for wage, and so coming to the accounting equation, this is going to increase, this is going to decrease our assets. It's obvious because we lost cash, and it's also going to decrease our owner's equities account because of this expense. So expense account always decrease the owner's equities account. So this is how it's going to affect the accounting equation. And coming to the ninth day, they said paid by check, the first installment due to Horn Trading, 12,500. So now I'm taking you back to I'm taking you back to day 3. I remember day 3. So day 3, we bought a truck. We bought a truck from our supplier. We bought a truck on credit from our supplier, Horn Trading. And so now we are trying to make our payments to Horn Trading. So we're trying to settle accounts. So this is our first installment. This is our first monthly installment that we paid to Horn Trading. So the two accounts to be identified here, we have Horn Trading, the creditor account. We have creditors, which is Horn Trading. You can either put creditors or you can put Horn Trading, doesn't matter. And bank, because this was paid with checks or bank account. So we debit the creditors account. Creditor's account, creditor is a liability, but then we have to debit the creditor account here because our liability decreased when we settled this amount. So our liability decreased, so we debit the creditor's account, Horn Trading, and we credit the bank account because we lost this amount of money from the bank account when we settle amount. So this is how it's going to affect the accounting equation. This is going to decrease our assets because we lost money, cash or whatever, cash in the bank. We lost this cash in the bank, so we have a decrease in our assets account. At the same time, we have a decrease in our liabilities account. The amount of money that we owe to Horn Trading will be reduced because we are now trying to settle accounts. So our liability account will also decrease with the same amount, 12,500. And the last transaction here, they say paid rent by check. It was 4,500. The two account here, we have rent expense and we have bank. So rent is an expense, so it's an expense. So we debit the rent expense account and we debit the bank account because we paid. We lost this case from the bank. 4,500. So this is how it's going to affect the accounting equation. It's going to decrease our asset. At the same time, it's also going to decrease the owner's equities account because when the expenses account decreases the owner's equities account. So this is the end of my today's lesson, and thank you very much for being part of these lessons. And I'll meet you in my next video. Bye.